The stock market is full of stories, some inspiring, some cautionary, and others that simply leave you in awe of the unbelievable twists and turns of financial history. Today, we'll be diving into 3 stock market stories that you absolutely need to hear. These are stories that not only shocked investors, but also changed the financial landscape forever. Whether you're a seasoned investor or just someone interested in the world of finance, these stories will leave you with important lessons about risk, reward, and the unpredictable nature of investing. So, grab your seat and let's dive into the top 3 stock market stories that have left an indelible mark on the financial world. 1. The dot-com bubble and the rise and fall of Pets.com. In the late 1990s, the world was introduced to the internet as a revolutionary technology that promised to change the way we live and work. This was the birth of the dot-com era, a time when hundreds of new tech companies launched with the idea of capitalizing on the growing internet boom. The promise of the information superhighway was enough to make even the most conservative investors excited. However, not all companies that capitalized on the internet boom were destined for success. One of the most iconic and ultimately disastrous stories of the dot-com bubble was Pets.com. The company was founded in 1998 with the idea of becoming the leading online pet supply retailer. At the time, it seemed like a brilliant idea. Millions of people owned pets, and the convenience of buying pet supplies online made sense. Pets.com raised millions of dollars in funding and launched an aggressive marketing campaign, including a famous commercial featuring a talking sock puppet dog, which made it a household name. In just a few short years, however, the company went from being one of the most highly anticipated IPOs to becoming a cautionary tale of the dangers of overinflated valuations. Pets.com went public in 2000 with an initial valuation of $1.2 billion. However, the company was hemorrhaging money, and its business model wasn't sustainable. The cost of shipping bulky pet supplies far outweighed the revenue generated from sales, and the company's grossly inflated stock price was unsustainable. Within just 9 months of its IPO, Pets.com was forced to shut down in 2000 after burning through all its cash. Investors who bought into the hype watched as their investments went from being worth billions to being worth nothing at all. The collapse of Pets.com, along with other companies of the time, marked the burst of the dot-com bubble, wiping out an estimated $5 trillion in market value. While many companies in the tech space survived and thrived, like Amazon and Google, Pets.com remains a symbol of the dangers of speculation and hype-driven investing. The story of Pets.com offers a powerful lesson. Just because a company is riding a wave of technological excitement doesn't mean it's financially viable. Investors must look beyond the hype and focus on the fundamentals. 2. The 2008 financial crisis and the collapse of Lehman Brothers. If there's one event in modern financial history that serves as a stark reminder of the dangers of excessive risk and poor decision-making, it's the 2008 financial crisis. What started as a real estate bubble ultimately led to the collapse of some of the world's largest financial institutions, sending shockwaves through the global economy. At the heart of the crisis was Lehman Brothers, one of the oldest and most respected investment banks in the world. Founded in 1850, Lehman Brothers had long been a fixture of Wall Street, offering everything from investment banking services to asset management. However, in the years leading up to the crisis, Lehman took on excessive risk in the form of subprime mortgage-backed securities. The real estate market had been booming for years, with banks issuing risky subprime mortgages to people who could not afford them. Lehman and other financial institutions were buying up these risky mortgages, packaging them into securities, and selling them to investors. These securities were marketed as safe investments, despite being backed by homes that were at risk of foreclosure. As the housing bubble began to burst in 2007, homeowners started defaulting on their mortgages in record numbers. The value of mortgage-backed securities plummeted, and Lehman Brothers was left holding a massive amount of worthless assets. In September 2008, after failing to secure a government bailout, Lehman Brothers filed for bankruptcy, the largest in U.S. history, with over $600 billion in assets. The collapse of Lehman Brothers triggered a global panic. Stock markets worldwide plunged, and financial institutions froze, unsure of the value of the assets they were holding. The failure of Lehman was a catalyst for the 2008 financial crisis, which saw the collapse of other institutions like Bear Stearns and Merrill Lynch, and led to a massive recession. The global economy would take years to recover, and millions of people lost their jobs, homes, and savings. The U.S. government intervened with bailouts for other struggling financial institutions and implemented regulations like the Dodd-Frank Wall Street Reform and Consumer Protection Act to prevent a similar catastrophe in the future. The story of Lehman Brothers serves as a powerful reminder of the importance of risk management, the dangers of excessive leverage, and the interconnectedness of the global financial system. It also serves as a warning about the consequences of ignoring warning signs and ignoring the fundamentals of investing in favor of short-term gains. 3. The GameStop short squeeze, the power of retail investors. In January 2021, the stock market witnessed one of the most unusual and dramatic events in recent memory. What started as a relatively obscure stock, GameStop, became the center of a global financial frenzy that captivated the public, the media, and investors of all types. It was a classic David versus Goliath battle, with retail investors on the side of David and institutional hedge funds representing the Goliaths. The story begins on Reddit, specifically the Wall Street Bets subreddit, where a group of retail investors discovered that GameStop, a struggling video game retailer, was heavily shorted by hedge funds. Short selling is a betting strategy where investors borrow shares of a stock and sell them, hoping the price will fall so they can buy the stock back at a lower price. At the time, over 140% of GameStop shares were shorted, meaning that hedge funds had bet massively against the company's stock. Seeing an opportunity to take advantage of this, retail investors began buying up GameStop shares, causing the price to rise. As the stock price increased, hedge funds were forced to buy back the shares they had shorted, which pushed the price even higher in a cycle known as a short squeeze. The stock, which had been trading around $20 per share, surged to over $400 in a matter of days, causing massive losses for the hedge funds involved, including Melvin Capital, which required a $2.75 billion bailout from other hedge funds. The GameStop short squeeze became a symbol of the power of retail investors and the rise of democratized trading. Platforms like Robinhood played a central role in allowing millions of small investors to participate in the event, but the incident also raised questions about market manipulation, the role of online forums in influencing stock prices, and the responsibility of trading platforms to their users. While the GameStop saga was thrilling for many, it also resulted in significant volatility. The stock price eventually crashed back down, leaving many retail investors with massive losses. However, the event sparked debates about the fairness of the stock market, the influence of institutional investors, and the growing power of retail traders in the digital age. The GameStop story is shocking because it demonstrated how retail investors can collectively impact the stock market, something that would have been nearly impossible just a few decades ago. It also highlighted the unpredictability of the market, where the actions of individual investors can lead to significant price movements and even force institutional investors to change their strategies. The stock market is a fascinating, unpredictable world, full of shocking stories that remind us of the risks and rewards that come with investing. Whether it's the rise and fall of a tech giant like Pets.com, the collapse of an institution like Lehman Brothers, or the revolution brought about by retail investors in the GameStop saga, these stories offer lessons that can help us all become better investors. If you enjoyed this video, don't forget to like, subscribe, and share for more insights and stories from the world of finance. The world of investing is never short of surprises, and we'll be right here to guide you through them.